Hi Year 11, this is Miss Rowe. Here is some videos I'm uploading for you guys for this new section of finance that we've been covering over the past few lessons. This should help you with your mock exams and it'll definitely help you with your exams in May and June. So let's start. So sources of finance. So you will learn methods businesses use to raise finance and the appropriateness of sources of finance. So firstly, went over a little task. Ignore that. Internal, external sources of finance. So you can have a look in your exercise books or obviously look in your folders under finance. I think it's section 6. Internal and external sources of finance. So internal, you got from within the business, which is family and friends, retained profits, sales of assets. Then for external, you got a new share issue, bank loan or mortgage, overdraft, trade credit, hire purchase and government grants. So obviously they're sources from outside of the business. Obviously we'll go through a bit more of this a bit later in the PowerPoint when I start going over the advantages and disadvantages, which you actually did do in lesson, if you remember the table with all the these words here, the overdraft, trade credit, etc. So you can fill them in as well if it'll help you. Okay, so what we'll do is go over internal sources of finance first. So think friends and family. Quite positive because obviously it's just between you and them. So it's just you and a family member or you and a friend. It's nice and easy. Might be an informal arrangement, and some issues you'll have is the amount of available credit may be limited. So you might say you need to borrow 2,000, but they can actually only lend you 1,200 or 200. So you just have to be able to see if you can get the money first. That's sometimes an issue when it comes to internal, unlike borrowing from the bank, which is external. So retained profit kept within business from profit after tax. So that's what you made after tax. From the year before, for example. Profit will either be retained or distributed as dividends. A business with an objective of growth is likely to want to maximise retained profit without alienating its shareholders. So these are examples of the internal sources. Internal finance obviously comes from inside the business. It can be quick and easy, but obviously it can also be good for paying back because you won't have to pay interest on most friends and family loans. However, obviously some businesses might not have enough to ask, but people to ask and have to find external sources anyway. So these are just kind of the things we need to think about. So internal sources also includes personal business savings, and like I said, selling of fixed assets. So there are some factors that do affect the choice of finance, which again we're going to go over a bit later in the PowerPoint. So for now I'll move on to internal sources of finance. So you can sell unwanted assets. An asset is something that is owned by a business, example vehicles, land, machinery. Or, for example, when I said about the shop, when I got rid of some of the mannequins because we had too many. So say we had 10, we got rid of 6. That's selling unwanted assets. We also had a spare till. That's something else we got rid of. These little things inside the business are things that you can class as assets, obviously. So a business can sell off assets that it no longer requires. Alternatively, it may choose to sell off an asset and then lease it back. So you might, for machinery, you might want to sell your combine harvester but then lease one instead. So you actually gain money for that from that. Provides an immediate one-off cash injection into the business, which is great, especially when you need to buy wholesale. So you could sell loads of assets, then buy 25 suits, and then you've not had to borrow from a bank. Right, external sources of finance. So shares represent ownership of company. So it can be obviously an issue if you have too many shareholders. If you hold one share worth £1, then you're a part owner. Whereas obviously if the company is like a multi-billion company, then it's you're only a tiny part of that business. Shareholders will receive a dividend, which is obviously their share of the profits. That's all it means. Dividend, share of profits. And you are given the voting rights. So similar to those seen on Batman. The amount of dividend payable will vary year on year and depend upon profit levels and company objectives. So it does change. Appropriate source for raising large amounts of finance, and the only option for larger companies. This again, external source of finance. Bank loans, mortgages, overdrafts, which we did go through in the lesson. So bank loans, set amount of money borrowed from the bank, normally for a specific purpose. So we did go over a little bit of interest rates as well. So obviously, say you borrow from the bank 10,000, by checking the interest rate, it might mean that you're actually paying back 13,000. So it just depends what the interest rate is, because it has to be paid on top of that amount that's been borrowed. Some banks require security on the loan, which is collateral. So this sometimes says, on adverts when it says, oh, you might lose your home, things like that, if you can't make the repayments. So that's house or your factory. They're the things you might lose. Mortgage, long-term loan secured against an asset, obviously normally a building. Also, interest has to be paid on the amount borrowed for that as well. Overdraft, ability to withdraw some money from a bank account than you actually have. Interest rates are often very high. So example, in lesson I said when I was a student at university, they gave me, I think, 1,500 overdraft. So when I actually got a position, and for example, I only got paid 1,700 a month, 1,500 was like swallowed by the bank account straight away. I could still spend the money, but it just meant I only had 2,000 in credit. So that's a lot of businesses have overdrafts, but it's definitely something you need to think about for external sources, especially when you're recommending these sources in an exam. So what we'll do now is I'll actually go on to the section where we're talking about things. So have a look here. So the advantages and disadvantages. I'll leave that up for a couple of minutes because you need to know the advantages and disadvantages of these sections. They are in your finance, sources of finance folder. So make sure you get that leaflet. You can add all these sections in as well if you missed it during the lesson. So you can pause the video now, get those in. You need to know them for your exam. These trade credit, hire purchase, government grants as well. So you might want to pause the video and update your booklet on sources of finance. Friends of family, retain profit, and a new share issue. So again, pause and get everything filled in. Okay, so the next section, little activity. State and justify an appropriate source of finance for the following purchases for a florist setting up as a sole trader: delivery van, additional stock, premises, and advertisement in a local paper. So obviously you can state and justify the appropriate source of finance. Have a little think about that. But also the next bit is how would your recommendations change if the florist were a limited company? Well, obviously we talked about limited companies in the lesson. You can think of it as you are you, but the limited part is basically where the owner of a business is not legally responsible for the debts. So it will be the business or the company that has the responsibility, not you as a owner. So what we need to think of for this, when you're thinking of appropriate sources of finance, just think of 4 factors. So size and type of the company. So obviously not all companies have access to all types of finance. Some types of businesses might not have any fixed assets to sell, because obviously this here, they're asking for, they want to buy a delivery van, additional stock, premises, and advertise as well. Number 2, think of the amount of money needed. So like obviously for this, you just recommending an appropriate source of finance, but think in an exam, size and type of business, this is a factor, amount of money needed by the business, the length of time it's needed for, is it only needed for 2 months or is it needed for the next 5 years, and then cost of the finance as well. So you've got to think of bank loans, and some overdrafts are more expensive than others because it has to be paid back with interest. You've just got to think companies in general need to make sensible financial choices to avoid difficulties in future as well. So you've got to think about this in the exam. The examiners love to test whether you can identify the right sources of finance to meet the needs of a business. So you have to think of yourself as a business. Make sure you know those factors before. So number 1, size and type of company. 2, amount of money needed. 3, length of time the finance is needed for. And then the final one is cost of finance. So how much do they need? Right then, guys. So I will see you in lesson.